Good evening, everyone. I'm Jeff Boccaccio, a member of the STA Executive Committee, and I hope everyone's had a great summer. And if you're in the UK, you enjoyed the heat and the unusual lack of rain we experienced, which killed my grass and everyone else's by the looks of it. Starting to come back now. And of course, all of us here in the UK and around the globe, we sadly mourn the passing of Her Majesty Queen Elizabeth II, who continues to be an inspiration to us all and demonstrates the value and the spirit of selfless loyalty and service. So that does not go unnoticed. Tonight, I am pleased to introduce Steve O'Hare, who's joining us today from the UK. Only down the road in Essex. Steve is no stranger to the markets. He's been at it for, 30 plus years, covering, by the looks of it, pretty much everything. Fixed income, equities, commodities, currencies. He started his career in 1987, which must have been interesting. I think I'm going to ask about that later on. But he started on the Baltic Exchange, so maybe that was a bit different, and then served with a few firms on LIFFE. Even more impressive to me is that, Steve kind of broke off from that to trade his own account in 1995. So anybody who can do that always has respect. In 2012, he got involved in a management buyout of PIA First, which I'm sure some of you have heard of, which became Signal Center, my understanding is after that. And they provide technical analysis based strategies and ideas for funds and traders and online platforms. We'll ask Steve about that a bit more, I'm sure, as the evening goes on. He's got a distinction in his STA diploma. That's always good to see. He's also got a certificate in global financial compliance with CISI or CISI, depending on how you say that. Now, before I hand over to Steve, the usual housekeeping, you guys know this by now, but when you get questions, please put it in the Q&A box below. That's easier to manage than the chat. So Q&A box for questions. And just one thing that I'm going to mention at the end as well, but I wanted to cover it here quick, is that a reminder for you to please join us for the drinks that we are doing. There's our now sort of almost usual September celebration drinks, and this is going to be on the 22nd of September at the usual spot with the Liberal Club. So we encourage everybody to come and join us. I think Steve's going to join us. He was mentioning before we came on, so that's going to be good and a lot of fun. So I know we're all eager to get going. So it's my pleasure to hand it over to Steve O'Hare. Steve?
Thanks very much, Jeff. I appreciate the introduction. It does make me feel pretty old, talking about over 30 years in the market. But yeah, I just wanted to do something a little bit different in my eyes. Being part of the STA for a number of years now, technical analysis has always been a key part to my history. So from trading to analysing and onwards and beyond, and really sort of like, I wanted to sort of give you a little bit of a history lesson of where I came from, and what we're doing now and what we're hoping to do in the future. So yeah, as Jeff mentioned, PIA First became Signal Center in 2018. We're regulated by the FCA. We were bought by a company called Acuity, which provide really look at sort of alternative data and provide news sentiment. That's one of their key tools that I'll talk about. And I was able to put this presentation together, and with the help and support of a couple of data scientists from Acuity, who I visited in Barcelona last week. So that's Ariel and Inez. Thank you very much for your support. And let me just move on, give you the history lesson, and drill down into the findings that we're coming up with at this point in time. So from the early days, I was always interested in trading markets. Obviously, Trading Places, the film from 1983, we all, I'm sure a lot of us, maybe not all of us were around then, but a lot of us became interested in the markets after watching this amazing frozen orange juice markets and film, which really sort of gave us a little bit of an insight into how trading really works. And from then, I really sort of tried desperately to get involved in trading in a big way. And my first experience was on the Baltic Exchange, as Jeff mentioned, in 1987. Now, that was a real amazing year. Obviously, as we know, the big storm of 87, the financial market crisis and the crash. And I was on the potato futures market at the time, which doesn't sound too amazing or extravagant, but it was one of the only markets open on that Black Friday. So that was my claim to fame. I made it in to work when a lot of other people didn't. Soon after, I transferred across to the LIFFE market. That was obviously there was a real appeal to me. It was a young, exciting market, all the financial futures, and I really enjoyed that open outcry experience. And soon after joining, around about 95, I decided to go on my own. I was backed by a couple of friends and traded my own account for the next 15 years. So there was certain things within that market that I really relied on. And it stemmed from the Baltic Exchange, actually, when I saw an old guy looking like he was playing noughts and crosses, but in fact he was marking price action on charts by hand, on paper, with a graph. And it was something that we saw on the LIFFE floor as well. But these guys were tucked around the back. They didn't sort of do it standing in the pit. They were tucked around the back, plotting the price action, and really sort of, that was my first insight. I really sort of sparked an interest in me, sort of understanding what they were doing. And the theory behind it was obviously technical analysis. And the idea was that by applying some effort into understanding what's happened previously in the markets, where the price has moved before, where support and resistance is, that could give us a good indication of where support and resistance may be in the future. So it was from a real basic perspective, that was a good introduction. The one thing that I think that LIFFE really had was a different type of analysis, which hasn't been replaced, and that was the noise analysis. And it may sound like a really odd thing, but one of the things that I remember very vividly is being in the pit and really using all of your senses, especially your hearing. That was key when new news data came out, or figures came out, or we had a fast market and orders were flying into the pit. We could almost tell whether there was a sense of panic or a sense of euphoria, where the markets were moving higher. People never panicked when they had to buy. They always panicked when they had to sell. And you could tell that by the screams and the shouts that were surrounding you on a daily basis. And this noise analysis went hand in hand with the other analysis I was using, which was the technical side of things. I would use the normal pivot levels, but also, try and pick out the previous swing highs and swing lows and look at different timeframes, not just the intraday timeframe. So really sort of like I felt like that gave me an edge, which in all the markets that we trade, we're always looking for some kind of edge. Unfortunately, LIFFE didn't last as long as we expected it to. So then there was life after LIFFE. What was that like? And the real thing that I noticed instantly was the lack of noise. I was staring at a screen with numbers moving up and down, and you wouldn't know where the spikes were coming from. Everything was happening so fast, and it took a good sort of 12 months before I found some sort of strategy that worked for me. And that was, there's a little bit of, again, trying to find an edge, but also using technical analysis as almost merging the two. The edge in that time for the next sort of 10, 12 years for me was really looking at the order book looking at, you know, where there's sort of like the big orders were, and merging that with the technical levels, and really sort of like trying to make money on a daily basis, trading around that type of thing. And then came, you know, skipping forward came the financial crisis, 2008, and the algos seemed to just dominate the markets around that time. And from then on, really, they replaced what was described as the locals, the sort of like the own account traders who were very keen on the intraday trading, and the edge sort of seemed to disappear. It was soon after that that I got involved with PIA, and we dived into a different world where it was really more about using my experiences from the past, using my knowledge of technical analysis, and using my trading savvy to create trade ideas based on technical analysis. So that brings me to what Signal Center does, and I'll just briefly explain Signal Center and Acuity and how I've come to this talk today. Signal Center, on a very basic level, provides trade ideas and analysis in around about 40 intraday markets. The most popular markets that we see, the FX markets, gold, oil, the indices. And what we try and do is we try and take the effort out of the traders' morning technical lookout, and give them an expert opinion on where we think the support levels or the resistance levels are on a day, and what we think is a good trading strategy. And over the years, what we've also done is we've started to introduce some AI technology into that. Now, that's quite basic at the moment, and it's something I'm hoping to develop over time. And so that's why this is quite exciting to me. It's a topic which I'm diving into at the ripe old age of 54. And I'm thinking, how many years can this keep me interested for? So we will see. I'm enjoying it at the moment. It's interesting to speak to data scientists. They don't have the knowledge that I have about trading, and I don't have the knowledge that they have about how to really utilize the data that we have got, especially the interesting alternative data that we're seeing coming through. And it is readily available now on numerous data providers. So the key understandings that Acuity really have around news sentiment, this is the one I'm going to focus on today. We've got multiple different data sets that we look at, but the news sentiment is really the one that I'm focusing on initially. So the sets of data derived from the vast volume of news published related to financial markets and key themes affecting all markets on a daily basis. I mean, I've even got an example of Trump, which and Brexit. So these are two old, you can see this in an old slide, but it's really sort of taking in the news stories. I think there's the numbers around 5 to 10 million news articles may be published each day. A trader hasn't got time to read all of these or understand them all. So really what we're using the AI for is to really read them and then come up with a sentiment score based on the positivity or the negativity of that story. And obviously with this, you'll get a lot of what's called false positives, where someone may be talking about dollar. I spent $1,000 on a PC, but that's nothing to do with the euro dollar. So it's really sort of like trying to mine through this data, and the data has got to be reliable as well. That's a key thing to it. Acuity's partnered with Dow Jones, so there's a good reliable data source behind there. And also they are starting to break into, or they have been trawling through the web, but it's really sort of like trying to get the real accurate data out there and try and focus on that rather than just any news or any tweet that may be unreliable. And what we do find, though, and one thing I've always learned in the markets, that news is a big driver of price. We know that from news events which we sit and wait for, the non-farm payrolls, the Bank of England, the Fed, all these sort of meetings. We're hanging on to the word, to that news, and especially now we're in this this rising interest rate scenario, something which a lot of people have never actually experienced. That's why I'm old. I know I've experienced the interest rate rises of the 90s, and what's going on now is a real weird world we're living in. You know, after the pandemic, we're coming out of the pandemic. Interest rate rises are going on, but not for the normal reasons, not for the normal types of reasons we get interest rates moving up. You know, we're trying to control inflation, but it's not the normal type of inflation. It's inflation which is really based around energy and food prices, which, you know, we're not sort of like going out and traveling further or eating more, but it's just a sort of like something which is, you know, we can't control. We can't curb our spending on this. It's, you know, we've got to pay for this in order to survive almost. Also, one key area of data I want to look at is also news volume, which is it's a proxy for market volatility. The more news volume you have on a specific story or a specific asset, that leads to volatility, and if that's positive or negative, it leads to the price movement. So the real news sentiment driving the markets, for me, is quite key, and I believe we can use it in combination with technical analysis to maybe get that edge that we're always looking for. Acuity itself came up with this word, infobesity, too much information. So let's just try and drill down into the millions of news articles and turn it into an insight really rapidly. And this is really only achievable using AI technology and processing that vast amounts of data on a really ultra quick basis. And what we do believe is, by understanding the current market sentiment, traders can better anticipate market reaction, market moves. So even the build up to events, we can start to see whether there's a positive build up before a big news story. Another key thing is trying to actually visualize this and make this easy to understand. And that's one of the challenges I feel that a product like Acuity has. You've got to really make this understandable from a trader's perspective. Obviously, from an algo perspective, you know that can crunch the numbers, but actually seeing the types of visualizations that Acuity are coming up with is quite exciting, and it's great to be part of it, because I can give an instant reaction on, I don't understand what that's showing me, or I do, I like it, and we can sort of like work together in creating something which I'm quite excited about, and I hope that is something that will be around for a good long while. So this is a little bit of an example of Acuity's products. It's a research terminal. There's a new research terminal just being launched. I'll show you a little bit of that, but this gives you a few pointers as to what we really look at. The new sentiment, there's different themes. I think there's about a dozen themes now that Acuity are constantly processing and looking for ways that that data can be utilized to improve performance, or to maybe forward cast sort of like ideas that are going that are coming into the market. We look at the bullishness, the bearishness of news articles. Fear can obviously drive the volatility. As we approach a big news event, the fear element will drive higher. That gives the trader an idea that something big's coming out, so to be a little bit more careful, or if he's wants someone that wants to dive into the market, creates an opportunity. The news volume as well, as I said, is like pretty key. The amount, the volume of the news is important, and obviously mixing that with the bullish and bearishness of the news story can give you a real heads up as to where things can go. Now, a lot of this is published on an hourly or a daily basis, and we can, this is something which I want to sort of like focus on in trying to bring it a bit more real time. The real time data is available, but it's just you know, finding the right sort of market for that, and being able to visualize it, which is a tricky thing. It's something we've when we write trade ideas, we've always had that issue. Writing our trade ideas, we look at it on a far more predictive analysis basis rather than a reactive analysis. So we look for, you know, the areas of support and resistance within the market rather than waiting for the market to break and then trying to get on that trade then. Then there's obviously always a bit of a time lag between us publishing a trade idea, which is reactive, and people or end users getting the benefit out of it. So the predictive model is something that we've really focused on over the years. As I say, Dow Jones is one of the major sources of this data and this news and commentary and analysis. So that's nice to sort of like fall back on that. The calendar itself as well, events in the calendar, looking at calendar events over multiple years and basically working out, you know, maybe there's a trade idea in there. That's this first instance of looking at alternative data to analyze to produce trade ideas. And again, something exciting that we're looking to break into over the coming time. So news sentiment. So how do we show news sentiment? Currently, the news sentiment is shown like this radial gauge that you can see. And if you look closely, it's not quite as clear as I'd like it to be, but you can see where sentiment is moving, and you can see that it's moving more positive. And you can see the dark green area is where it was previously. And this is done on a 24-hour model. So we can see that news sentiment over the last 24 hours has moved from about 30% positivity to about 50% positivity. Also within this, you can see the next calendar event is in 1 hour and 57 minutes, and also the fear index, which will basically give you an idea of what that story is, whether it's a high impact, a low impact, or a medium impact story. So how do we actually come to this news sentiment score? Well, what we do is while we're reading all these stories from an AI basis, we're looking at the positive negative ratio of that story. So if we analyze 1,000 stories on Apple, and we'll come up with a more positive more positive sentiment has come out of those 1,000 stories than the negative sentiment, then that will move the news sentiment gauge. And again, this was one of the keys for what I wanted to do and how I wanted to improve what we did at Signal Center. So when we had the opportunity of being bought by Signal Center, this was key. Something that excited me, something that really I believed could improve our product and potentially become a market leader. That's obviously everyone's dream, everyone's goal. So obviously the sentiment in the bottom image, that's moving more negatively. Sentiment is moving bearish, and this is almost doubled. You can see almost here we were 50% negative on this asset, and it's moved to nearly 100% more negative news sentiment. So let me take you on to the market alerts. So this is basically Acuity's version of maybe what Signal Center does. The market alerts are they're unique. They're to Acuity. They're news sentiment driven indicators. And so what they do, they offer traders an alternative to trade ideas, which is also based around the confidence factor. So if we look at the top one, crude oil is a 70% confidence of a negative move over the next 12 hours based on the last 10 events that we've seen the same sort of moves in news sentiment prior to this. So we look at the last 10 times that news sentiment has moved in the same way, and we come up with 70% or 7 out of the last 10 occurrences, the market or the price has moved lower in the next 12 hours. So this is like the hour, breaking it down to the hourly side of things. So that these are all calculated using a mathematical computation that I don't get involved in yet, but we'll see how that can change. And you can obviously filter this. You can look at the more highly confident rated trade ideas and yeah, adjust the confidence slider on the top to help you with this. Also, at the same time, what we do is we show a chart. This chart is a good indicator. And on this chart, you'll see that it has these green and red chevrons. Now, that's when the market alerts are produced. And so they're not just published in a market alerts side page, but also on a chart to give you more of an idea and maybe gives you the first sort of indication that maybe sentiment is maybe a driver in the markets. And we tend to find this. Now, the sentiment score on this is based on a 7-day EMA. The actual indicators themselves, the market alerts, are based on a crossover system. So that is a moving average, an exponential moving average crossover system. So that's why you'll see a buy, then a sell, then a buy, then a sell, and it's constantly where the moving averages are crossing over. Now, if we were to strip the percentage confidence in this on this chart, we could possibly see that the negative sentiment or the selling market alerts were more confident than the buying ones. I can't actually show you a live version of this to prove it. Take my word for it. I've looked at many of these over the last couple of years. But again, if we look at new sentiment, we can see that sometimes the new sentiment is driving the market lower. We can see it's generally the market new sentiment is moving lower, and price has continued this move lower. And we got a bottom out around about the middle of September here. And new sentiment, you can see spiking higher now, and you can almost see that the sentiment has moved higher, and the buy trade idea or the buy graphic was published a bit later, which almost felt like it was too late, but price has held and continues to look to push higher. The charts I've just gone through really probably explained everything that's on this chart. That gives you another instance of where sentiment has moved lower, continued to move lower, and price has gone with it. These are all also partial boxes which show the news volume, extremely high news volume and fear compared to the normal average. Sorry, I'll take you back to that one. This would possibly be just before a big news event in the US, and obviously dollar yen being one of the major FX currencies which moves on that. So the news volume is really the amount of news that's been published in the time period. So if it's an hourly or daily, you could select which one you want to look at. It will adjust the graphic to sort of take that into account. And this is compared to its normal average volume. So if you say like there's normally 100 news stories a day, all of a sudden we've got 200 news stories a day. Let's take a look at that market. There's something interesting going on there. It's above the norm. If there are no bars highlighted, then that's just normal market conditions. And maybe we'll see that news sentiment maybe isn't driving that. There's maybe something more technical or even fundamental behind it. The fear is the amount of fear being expressed towards the asset, and this can indicate wider market impacting events such as, again, coronavirus or Brexit, probably an old slide now. We've moved on from there. And now I'm sort of like moving towards like a more modern day version of what Acuity is really bringing together. And it's really sort of trying to bring all these different data sets in. So we're not just looking at news sentiment, we're also looking at the news volume and bringing the price volatility and the price momentum into the equation. And this is the Acuity Opportunity Score is a new model that they brought out. And this can look at single stocks, all the thousands of single stocks that they cover, and can give it a really good snapshot of really where the market is at the moment, how it ranks within its own sort of like amongst its peers. It's compared with the a group of assets or a sector, and this overall ranking is produced, the 56 out of 111 you can see on Tesla. This is a breakdown of the opportunity score, which is basically shows you how the price trend has moved as well. So we can see that price trend has moved bearish from its, well, it's still being classed as bearish. It's moved from its previous score, which was very bearish, to bearish. You can see that here, highlighted here. The sector average remains bearish as well. On the news sentiment side of things, Apple's neutral at the moment, and the sector average is slightly more than neutral, a little bit bullish. So this is a good way of comparing individual assets against other, as I say, the peers itself. The volatility is based on the current price movement comparison with the average. So we're taking prices into account with this opportunity score as well. This uses an ATR, and it's an ATR-based calculation. And you can see that Tesla here is moving higher. It's above average, whereas the sector average remains subdued. And then the news volume, again, this is based on the relative change of volume, a score produced by the Acuity Sentiment Analysis engine. It compares the current news volume with the average volume and returns a value indicating an increase or decrease in the news volume. When the relative change volume is above average, this means that the instrument is receiving unusually high news coverage. So again, sort of, being aware of that just will highlight that opportunity to the end users. So why did I sort of like bring all this together or do a talk today? I wanted to do something a bit different. I wanted to, basically just share what I'm involved in and what I'm looking to get involved in. So this is quite a new process for me. So what I wanted to do, I wanted to basically try and see where I could improve potentially what the technicals on the signal center have done over the last few years. So it was almost to sort of take into account that news sentiment may be a driver of momentum. And if we understand the news sentiment and where that's moving and how that's moving, then maybe we should really focus on a similar type of trading strategy or trade idea based on that news sentiment move. So a positive or negative change in news sentiment tends to result in that change in price. So throughout my trading and analyzing career, I've always felt every day there's two perfect trades, selling at the high and buying at the low. It's an obvious thing to say. So I will never criticize an analyst if the market's moving lower, momentum's bearish, and he comes up with a buy trade idea. But there has to be some sound reasoning behind it. We've talked, we can talk about catching knives, catching falling knives and things like that. And there's a lot of other words I can think of right now, but I won't repeat them live on air for you all. But I wanted to sort of like try and prove or disprove the theory that news sentiment can improve our results by maybe backing a bias or providing a bias for the analyst to come up with the trade idea for that day, because we really focus on the intraday trade ideas. So let's take a look at where the news sentiment is or driving from over the last 24 hours or even over the last few hours, to give us an indication of where that follow through will come from and where that news is driving the market. So the idea was the analyst can be guided by the news sentiment, doesn't have to follow the strategy, but if we look back and the results are improved, then maybe it's something we've got to dive deeper into, and that's where we are. So to test this theory, I needed the help of my data scientists because they can do all the messy work. So they were able to provide the news sentiment scores going back over the last couple of years. I was able to provide the trade ideas which have been triggered on our strategies over the last couple of years. These are all theoretical. I should have put a big disclaimer somewhere, but bear with me and you'll understand a little bit more about where I'm going with this. So the strategy basically is to filter out the trades where news sentiment was not in line with the trade idea that we generated on that day. If we were able to prove that this improved results by a decent amount, then maybe that this could be a real indicator that's telling us that news sentiment should really drive our bias for the trading day. When we looked at this, I did a couple of commodities, and I thought the negative correlation from the news sentiment and price would be relevant. I was proved wrong in that, but I'll break it down. So I don't mind admitting I was wrong about some things, but I'll come up with some sort of excuse to make it sound okay. So let's break it down. So this is our gold results that we've sort of like, or since 2019 this goes back to. So we've got our track record which goes back to 2015. And we sort of analyze these from a performance metrics, continually looking at ways to sort of like really show maybe the potential success of what we do. And we try and make it a bit realistic as well, having a small amount of capital, risking 1%, which isn't small. Well, it can be small or it can't be small depending on what the capital is at risk is, or doing a fixed risk. We can look at both options. But over time, and since 2015, I think pretty much our win rate is not far away from what is showing on gold here, around about the 45% mark. It's been a little bit higher on some assets. It's been a little bit higher recently, where we're sort of starting to introduce the news sentiment into our analysis. But the sum of each individual trade, we've compounded these results. So as the account moves higher, you're risking more on a sort of trade basis. That works well when you're trading well, or when the performance is going well. Not so much when it's not. But if you take the sum of each individual trade, so basically take risk 1% on each trade idea in gold over that time, we had 277 trade ideas, 125 of them were winners, 133 losers, 19 flat. This is when we used to move our stops. We've stopped doing that now. But what this did, that if we married it up with the news sentiment, it filtered out a certain amount of trades. And the net result was a positive result. Now, this positive result was from inversing the correlation. So let me explain a little bit about that. We would look at the news sentiment, and if news sentiment is bullish on gold or positive towards gold, that wouldn't necessarily mean gold price would go up. So this led to the basically us looking at inverting the correlation. So gold is a safe haven asset, as we all know, and when the markets are in a risk-on mood, things are looking good. News on gold could be positive, but the price on gold basically moves lower because of it'll be more inclined to be a safe haven asset. So on a risk-on approach, price will move lower. Also with gold, it's very much dominated by the dollar because it's priced in dollars. That's the main market that people look at, the gold against the US dollar. So for instance, over recent months, we've seen the dollar move higher, and we've seen obviously gold move quite aggressively lower. Even today, seeing figures out today, prices moving lower in the gold aggressively based on the dollar, not necessarily based on gold. So looking at this from more of an inverse correlation, the results were improved by around about 8R. Well, I've exaggerated there, that's 7R or just. So I'm sure I'll get picked up on a few things I've been mentioning, but I wanted to sort of like show gold initially. For me, that has shown an improvement. So if new sentiment in gold is positive, then maybe we should be looking for a sell trade idea. That's the nuts and bolts of it, and that's something, you know, we're trying to prove or disprove. On crude oil, I thought it would be a similar process, but we found that using a standard correlation, whereas if new sentiment is positive in oil, then we should be buying. If new sentiment is negative in oil, then we should be selling. This results in WTI crude oil win rate lower. Overall, over that period, we were down 5.47R. And if we were to have only take the trades that married up with so positive new sentiment and our buy trade ideas, or negative new sentiment and sell trade ideas, then it improved the results by 7R. Again, it's nothing to be sniffed at. We saw a similar thing in Brent crude oil. We haven't been trading Brent crude oil. I think we've only been analysing, trading it for about a year. Good positive start, but we've seen the analysis not working very well, leaving a net result of minus 3.4R. So that's saw a 4.4R improvement on the standard correlation. Euro dollar saw a really marked improvement over the last, well, since 2019. Since then, we've seen a negative 13.7R return in our Euro USD trade ideas. You can see the win rate is down on this. For me, one of the most difficult markets to analyze and to probably attach a trade strategy to. But if we maybe thought about new sentiment and based our trade ideas on following new sentiment, then we can see that's a huge improvement, about 14R. Similar sort of thing in cable. Again, performance hasn't been great in cable, and we had a net result over that 2-year period of negative 8R. With the use of the standard correlation, that improved by 8R, so that gave us a flat reading. Now, what are the, I've saved the best to last, obviously, because I didn't want to basically sort of like end on a sour note. But well, it's saying it's the best to last, it's obviously had an impact. So without using any type of new sentiment on this, our results on the DAX over that period are a lot better. Or 71.64R, which is a sharp ratio of 2.6. Oops, sorry about that. And a really small drawdown. And this has been one of our most consistent performers over that years. And you can see almost a 49% win rate. All of our strategies on the intraday basis, we insist from our analysts on providing at least a 2-to-1 risk reward. One of our top analysts, obviously, on DAX, he probably took over from me, I'm sure. But yeah, great results. Then when we applied the new sentiment correlation on this, obviously it will filter out some of the results. So the positivity drops off. But then this is obviously just filtering results. So it would be expected if you filter results, the performance isn't going to be as good, because you're taking away a lot of winning trades. So there's a lot more work to do on proving or disproving this theory, but this is just the start of it. So for me, what I've seen so far, it gives me confidence that we're going to be able to create some sort of tool which can assist our technical analysts on a daily basis, and then in turn that will improve results all round and performance all round. So that's the plan next, really, to continue to investigate the additional correlation between news sentiment and price movement. Our data scientists really have only really looked at the news sentiment in the last 24 hours moving positively or moving negatively. We haven't dove down into by maybe how much percentage they've moved by. Does that improve performance if it's moved by a bigger percentage or not? Also, we're going to be studying far more alternative data sets. So I'll be a very busy bunny in the coming months and years, and look for, you know, further potential correlations, and really sort of like focus on almost bringing all this analysis together. I've always felt like technical analysis is a great tool and something that a trader needs to understand and can use and can utilize from time to time. When it's combined with other types of analysis, I think it becomes far stronger. And I know that from personal experience and what we're investigating now. We're going to look at additional assets as well, and almost cross-referencing different assets. So maybe looking at the gold along with the euro dollar, along with the trade idea and things like that, almost bringing different assets together. The idea is to provide supportive tools, AI supportive tools for our analysts to improve the trading strategies that we give. And yeah, it's sort of like, hopefully that reaches more people, more traders globally. Designing and creating the UI is really important, making it understandable, making people understand what they're looking at, rather than just looking at a really nice image, thinking, oh, that looks lovely, but really not understanding how to use it. So for me, that's a key part to it. And with my trading experience, I'm going to really sort of like work hard to make sure that that does create that opportunity. And yeah, really sort of like combining everything to create some sort of fusion analysis. I'm sure that word has been bandied about before, but I'd like to sort of put some sort of trademark on that. I don't know. But yeah, I sort of hope you've enjoyed what I've gone through, and I'm happy to field any questions.
Steve, thanks so much for going through that with us. That was really interesting, and I mean, I've got a long list of questions here.
Oh dear.
I think, you know, let me kick it off with myself, just to clarify a few things that maybe some other people are considering as well, or just trying to get clear in their heads. Could you clarify first the difference between Signal Center and Acuity? Are they two different products?
Yeah, well, Signal Center, basically Acuity was provided widgets and EAs for the same client base. So we were both providing these our tools for retail online brokers. Right. But what they didn't have any technical analysis based around their instruments, and it was something which they lacked. So they bought us in March last year, yeah, so we were very much coming from the technical background, technical analysis and trade idea creation and generation, and they are from more on the news center and the big data, the alternative data environment, trying to produce trade ideas from that news sentiment.
Gotcha. Okay, so the news sentiment piece is actually coming from Acuity, and then it's the combination of that with Signal Center, which is kind of giving that extra bit of juice. Exactly.
Yeah, we're really sort of, the idea of this whole sort of project was to really see whether we could improve the Signal Center results on a historical basis. If we could prove that, then moving forward, we can then engage with our analysts and provide the tools for them to get them the right side of the trade ideas more often. So we're hoping to see a spike in the win rate, which will naturally lead to a spike in the actual performance overall itself.
Gotcha. Yeah, I think I understand. And so from a user's perspective, are they two separate products today, Signal Center and Acuity, or are they combined in some way?
Well, we've created some widgets which can turn into an EA on MetaTrader platforms,
Yeah.
and they all come through the same API. So we have an API which firms come to us, they want to get the data from us so they can get the signals and they can get the news sentiment and they can get all the widgets from one source. So we are fully owned by Acuity. There's still a little bit of separation there, which will probably remain for some time, where Signal Center is PIA first, which is the regulated entity. So, you know, we have to do everything in the right way. Not that I'm saying Acuity don't do anything in the right way. That sounded wrong.
Understand.
But we've got processes and that we have to go through from the regulatory side of things, which then sort of like, so that keeps that separation there.
Gotcha. Yeah, you need to tick all the right boxes.
Exactly.
All the regulations. Okay, so one of the other questions that I had was, what I think you've already answered it. Actually, is the underlying calculations for the sentiment analysis. So, say the news sentiment. Is that available via an API for those that might want to tap into it for their own use, like directly to get it from source?
The actual calculations themselves wouldn't be available via the API.
No, I don't mean but the results.
Yeah, the results would be available. Yeah, exactly, through the API. So, you know, one of the sort of like the client or the markets we're looking to target when we sort of like really build on this next year is the hedge funds, the banks, the sort of like the institutional traders who like to take the data, but we need to make sure that it's almost understood what sort of data we're providing to them, and they can then manipulate it in their own way to work for them. So that's definitely sort of like where, you know, we're targeting as a market over the coming years, the institutional side of things. The retail side is, you know, we're sort of like feel pretty confident in that area, but it's all about the visualization of the products. It's no good sending just like raw numbers to you know, an end user on the retail side. He needs to see have some sort of visualization to understand exactly, you know, what he's seeing, what he's reading, to give him an opportunity to benefit from it.
Sure. So how do people get access to those visualizations that you shared in your slides today?
Well, a lot of them are available through the brokers that we work with. There's no direct retail client market that we sort of like we cover. So a lot of the brokers that we work with will have them either on their platforms integrated almost under maybe a white label type of scenario, or they'll have them on their MT4, MT5 platforms. They seem to be the most popular, the quickest, the easiest to integrate. We can get someone with an MT5 platform, we can get them up and running with the widgets in less than 24 hours if we pull our finger out.
Gotcha. Okay, so by widgets, it sounds like you mean you can get those actual visualizations integrated inside the actual MT5 or 4 terminal, yeah. So it's there on your trading platform, and the distinction is that it's the brokers that come to you guys to say, hey, we'd love to provide this information to our clients, yeah. And then you work with the brokers and then they make it available. So is there a list of supported brokers somewhere?
There is a list of supported brokers on the website. I'm sure in our presentations, I feel a little bit embarrassed I haven't got a list to show you now, but I can run through a few. We're providing services to people like Saxo, IG, Oanda, Markets.com, and a lot more. So I think we've got about 50 brokers we're currently providing for at the moment. Still a lot more brokers that we're coming after. So if you're out there listening, we're coming for you.
Fantastic. one of the questions that came up was with regards to the analysis that you did there, sort of showing the comparison between, if I understand it correctly, was it the raw signal center trading signals versus those same signals, but using the news sentiment as a filter on those signals? Is that right?
Yeah, absolutely. That's exactly what it is. So we took this, the score, you can see the sum risk reward here. That's all the individual trade ideas with using a 1% risk scenario. And the return was 16.46 over that 2-year time period. So what we did was every time we had a buy trade idea, and the data scientists would historically go back and work out what the new sentiment score was for that preceding 24 hours. So a lot of time and effort went into that. So again, I'll thank Ariel and Inez, and that improved the score. So that would sort of have basically filtered out some of the losing trade ideas that we had. So some days we would have been buying gold when news sentiment was negative, so that you'd lose them, and some days we'd have been selling gold when the news sentiment was bullish.
Right.
So a lot of this is it's almost taking the actual analyst's bias away to a certain extent. We haven't sort of like fully decided whether they have to go with this, but if we see the results that we've seen from just the initial interpretation of the results, the initial investigation, then it would make sense to follow this path. And that could even lead to even better results. The amount of days that maybe we were looking to buy when news sentiment was negative and we didn't get the buy triggered or something like that, and we missed out on the sell opportunity. So, you know, I feel like there's definitely something to investigate more with the results that we found so far. And these results have only been literally, I was working away at lunchtime this afternoon to get, you know, get a little bit more data on more markets. Initially, I was going to look at a couple, but I thought after seeing the results, I wanted to sort of like maybe push that a bit harder.
Yeah, no, it's really interesting. And just to clarify for everybody, I think if I'm understanding the chart correctly, the equity curve that we're looking at here, there's two lines, a dark blue and a light blue, but those are representative of the original score, I guess. So in this case, it would be the 16.46 R, right?
Yeah, well, basically this would be compounded. So what we would do is we would so the 16.4 R would be if you took each trade idea that we generated, so out of the 277 trade ideas, and we used a 1% risk on each of those. These are compounded using either a fixed £10 or $10, whatever the account size may be, or a 1%. So once the capital of the account builds to maybe 10% by 10%, like as it did in September 2020, then you're starting to risk 1% of 1,100 capital.
Understood.
So you start to, yeah, that would be more of the, yeah, sort of like compounding effect of what we can produce. Without the compounding effect, the result is actually improved. If you look at it from there, 16.46 is just a sum of risking 1% on each trade idea. So all them trade ideas that one put together. Maybe another question that people come up to is whether we took into consideration, because there's a lot of trade ideas, the actual cost to trade. So we did. We basically what we did, we set alerts on the IG trading platform, in fact, and if we were looking to buy gold, say at $1,800, and if the IG platform was $1,801 offered, we wouldn't take that as although it might be $17.99 bid, say there's a $2 spread, we wouldn't take that as filled. It would have to go offered at our bid price to actually get filled. So that's basically taking the spread into account. And then if it got stopped out, it would obviously get stopped when the price is actually sort of like offered or bid. So basically, if our stop is at If we're bought it at 1800 and our stop is at 1790, if the market goes 1790, bid at 1791, that gets stopped. So you're actually sort of, it sort of like covers a little bit of slippage, not a lot.
And I gotcha. There was a question which was related to stops, and I'll just read it as it comes in. And I'm not sure I fully understand it, so we could possibly ask KC to clarify. But he or she asks, what was the reason to stop moving your stops?
Good, very good question. Because this is something I really enjoyed. I enjoyed sort of adding my my trading bias to the performance of the signals, and I felt like if I go back to maybe 2012, before I bought PIA with Ian, my business partner, the way they were sort of giving their performance for me, because I used it as when I was trading as well, PIA, just as a sort of like a supplement to you know, my trading. And I felt like the way they were sort of like showing the performance wasn't as clear as the way I wanted to do it. I wanted to be a lot more open and basically a lot more open to sort of like question. People can say, why, you know, show me your performance, how would you do that? So we made, you know, it's something we did in 2015, and it was like a bit of a risk, because we thought, well, our performance could be horrendous over the sort of like next months or years, and no one will sort of think, oh, well, we don't want to sort of like use your analysis because you're rubbish. But it seemed to work. We believed in it, so we thought we'd go with it. Now, what we also did, we had a tool built in 2019, 2020 maybe. And what this tool did, it looked at all the trade ideas we'd ever done, and it basically analyzed what we would have done, what the performance would have been if we didn't move the stops, and what the performance would have been by moving the stops. And the analysis we did at the time proved beyond a doubt that we shouldn't move our stops, and which is a really difficult thing to do, because there were some days when you had a trade idea saying gold, and it was you're buying at 1800, your stop is at 1795, your target's 1810. It's a 2-to-1 risk reward. It gets to 1809, and then you think, well, surely I'm going to get filled here, and you don't get filled, and then it moves all the way back, and sometimes maybe even stop you out. And then you sort of like think, well, my trade management was poor in that respect, because you're $1 away from making 2-to-1, making $10, and you're $14 away from losing, you're sort of your 1%. So we had to analyze it all, and over the course of all the trade ideas we did, it showed us that we shouldn't move the stops, because that sort of impacted negatively on the performance. So yeah, it was definitely something which we were very much more active, and it's sort of like there was a lot more work to do, a lot more updates, a lot more watching the markets, but in the end it wasn't helping the performance. So it just that sort of like, because sometimes now we have trade ideas, like today I think we sold the 3 US indices. One of our analysts sold all 3 US indices, and they all collapsed, and they ended up with even sort of like 7 or 8 R return just on one day from them 3 markets. So that's like a huge thing. And some days you get it where you move your stops, you get stopped out, and it carries on and hits the target. So yeah, that's the reason we stopped doing it, because we analyzed it. Yeah, and it's a bit of a sad day, because I felt like I'm a little bit less involved.
Well, it should give you some time back. I mean, I've found the same, and I've heard many guys say, stops in general tend to deteriorate performance, which sounds ridiculous, but it tends to be the way.
Yeah, stops are for buses. I've heard that a lot.
Right.
As well.
Yeah. Right. But you got to have them, but it doesn't mean you have to move them, right?
Yeah. Exactly.
And so it's if you could just set and forget, and then come back and see what happens. then yeah, it should be less cognitive load really on you guys, and just leave it as is and move on to the next trade.
Yeah, exactly. It allows us then to sort of like focus a lot more on the, creating more trade ideas, more strategies, covering more markets. And, hopefully, with the help of Security as well, we'll be in a position where a lot of the, our updates are done automatically as well. So we can just really sort of like focus on the quality of the analysis, and really sort of like, just like, as you say, just set and forget. I mean, for me, when I look at trading, or when I trade, I'm very much focused maybe more on the stop than anything else, thinking, right, I'm bearish of this, I'm bullish of this, where will I be wrong? So if that's where my stop has to be, then here's where my target has to be. And if the risk reward isn't right, then you've got to just like sort of like say goodbye to it. And sometimes you maybe miss out on opportunities, but it's really sort of like trying to get that discipline right.
Right. Gotcha. This is so. Just for my own understanding, the signal center. You've mentioned your analysts a few times. So are the signals generated by human analysts, or are they mechanical signals?
Yes, all human analysts.
Okay.
We don't have any automated trade ideas, not on the signal center side. Acuity has then automated strategies based on news sentiment. And I'm not saying we'll never have automated strategies, but I think it's, for me, I've always thought it was really important have that human element in. If we get some, the bots or the algos creating trading strategies, at some point in the future, they'll all be saying the same thing, the markets will stop. So that's my excuse for sort of, explaining how important the human element is.
Right. So, and just to further clarify, I think I know the answer to this, right? But on the chart that you've got available there on gold, the equity curve is based on the signal center human analyst actual returns, and then and that's the 16R, 16 change, and then the 23R is when you took those same results and applied the sentiment filters on top to just give them that little extra boost.
Yeah, absolutely. And I was sort of looking at all of the products that we looked at. We looked at 5 in total, 6 including the DAX as well. But all of them were improved. I really like the Eurodollar, because it's for me that sort of like shows that our performance could have been vastly improved. As I say, if we actually sort of like produced an opposing trade idea instead of buying it that day and we sold it, that could have produced a positive performance on the R side of things as well. It definitely would have produced a more negative one because we lost that 1% or 1R. So I'm sort of excited really about applying this, and so I think it is, we've proved it historically that it's improved the results. Now it's like moving forward, let's see what we do from next week, next month, how we can maybe produce, we can measure it by getting the win rate higher, improving the performance. And yeah, that's how we sort of like measure ourselves anyway. So yeah, it's really sort of quite exciting.
Yeah, certainly. So a quick question on Eurodollar then, for the news sentiment on a currency like Eurodollar. Are you guys combining in some way both news flow for Euro and for dollar, and sort of like doing the combination? So if it's bullish Euro but bearish dollar, then that's sort of like even more bullish for Eurodollar?
Yeah, good question. It's something I asked the data scientists today as well, because it's really sort of me learning and really understanding the sort of like the nuts and bolts of the actual news sentiment scoring, how they come to that, how the model works. I don't want to get too involved in it because it's not my expertise, but yeah. So no, this would basically take the euro, where euro dollar is mentioned as a pair.
Right.
And basically base it on that. So, and it's something again which I thought about. The one thing I did think about was how the price of euro dollar, or maybe the price of the dollar basket of dollar, the dollar index, impacts on gold. Can we use euro dollar as it makes up 56% of the basket of dollar index? Can we use euro dollar, the new sentiment in euro dollar, along with the inverse new sentiment in gold, and apply that to the gold trading strategy? And that's something I want to investigate a bit further, using maybe multiple assets and combining them in a way that where they are linked, where they are related to a certain extent. So obviously dollar drives gold, and then our sort of technicals that we're looking at on top of that, and sort of like coming out with the right strategy. So yeah, very much early stages, but we're sort of going to look at all of those opportunities.
Very good. Just a couple more, if you've got the time. I'm aware we've run over a little
sure.
bit. The news sentiment piece of that, is the news sentiment alone available as an API that somebody can tap into for their own use?
Not on a personal level.
Okay.
On a corporate level, it is. They can tap into that. It's not available direct to retail though.
Okay. And on that news sentiment analysis, I think you mentioned this, but just to further clarify, I think you mentioned, is it a 24-hour window for that news flow? So it's like always going. And so you mentioned news volatility, and like the number of news events is relative to the market volatility. So that's in, like, if there's more news events within that 24-hour period, then that would include, or that would suggest market volatility is higher, and then that would fall off at some point as people aren't talking about it anymore.
Yeah, exactly. So it will look at between 12 midnight and 12 midnight the next day. That'll be the 24-hour window, and then you have the hourly windows as well. Okay. And it even drills down to real time. So there is that opportunity, but the real time is pretty messy. So, yeah. But yeah, the hourly, you know, we haven't sort of like drilled down to that hourly time frame. So normally when we write our trade ideas, we're sort of up at 6, 7 o'clock in the morning UK time. That's when we do the majority of our ideas. We do around about 20 then. Then we sort of like build out and we look at the US indices, and then we also look at the Asia Pacific markets and look at the Asia Pacific indices, and a couple of, well, about 5 or 6 different pairs which are more traded across that time frame. So yeah, it'll be interesting over, you know, this time period now where we're looking at the hourly as well as the daily. So the daily is what we've done our back testing on, so that's key, but maybe we can also do the daily, also integrate hourly into that factor in the 6 hours between midnight and 6 o'clock to sort of see if that trend is continuing, and if it's continuing, maybe be a little bit more aggressive with the trade idea, be trying to get in at maybe a sort of like a resistance or a you know, support level, depending on which way we're going, but trying to be a bit more aggressive with the entry level. There's a lot of times when we write trade ideas and it moves in that direction over the day, but we've just missed out on the opportunity because we haven't actually triggered the trade idea.
Right. Another question's come through. This is for, at Signal Center, do you use a programming language to analyze markets from other perspectives for clients? And I'll read it as is, and then we can discuss. If so, which one? And do they do numerous back tests with that programming language? Now, it sounds like Signal Center is the sort of, that's the human analyst, right? So does that make sense from a Signal Center point of view?
Yeah, we basically employ our analysts, and we've got a platform. They basically go into that platform. They obviously annotate their chart. They go into the platform. They write their strategy, why they're buying, why they're selling. They enter the support resistance levels. We don't use any type of programming for that. It's actually the analysts themselves have direct access to our trading platform. And yeah, so I don't know where the questions exactly which angle the question's coming from, but I don't know whether I answered that correctly.
That's all right, Javier. If we could, if you want to clarify, happy to pose that back to Steve here. One other thing that I was going to ask, I guess it's with regards to the news events, right? So there's news, as in like there are people, articles, tweets, all of the things that you mentioned that will factor into that news sentiment analysis. And then there's like scheduled economic news, right?
Yep.
So those things like non-farm and well, today was CPI, right? That really kicked things off today. The market is not liking that. And so I'm wondering if maybe in the analysis that you've done here, it's going to be based on your own signal center analysts. You mentioned one of your analysts, what got in short on the equities today. I'm assuming that was probably pre-news, or do you guys take those economic news events into account?
Well, we do take them into account, and again, we've analysed strategies around the news events over time as well, and obviously there is the issue with the sort of the spike in the volatility around big news events, and it's very easy, market spreads widen. It's very easy to get stopped out, much easier to get stopped out on specific news event on an intraday basis than it is maybe on a longer term basis. On a longer term basis, you're looking at a much wider stop and a much wider target. So yeah, we maybe look at our analysts are allowed to be a little bit more defensive when we have news. We're expecting high volatility news events, but over time, again, we've analysed it and found that the results are, the win rates are pretty much similar when we do have like non-farm payrolls or Fed meetings, and yeah, so it is. We know that you're going to have that period of volatility just after the release of the news event, but we sort of like, we're happy to accept that there is that potential for getting spiked out and then it going your way. I mean, we've seen it plenty of times, but you just got to, it's part of the game.
Gotcha. Yeah, no, totally understand. And if you're managing your risk, it shouldn't necessarily be an issue unless you're getting slipped on the event, which happens.
Yeah.
My partner got spiked out on a short ES ahead of the number because there was some shenanigans happening right before the release today. Right?
It's
like
amazing. It's amazing how they know.
Yeah.
It does feel thin, if right? You just get rid of that camera just behind you, it's like looking at what your position is, you'll be fine.
Right. But the market gets thin, right, ahead of those events, so it doesn't take much to move it around at that point, which maybe brings us full circle, and we can start to wrap up here a little bit. But I wanted to ask you about how the open outcry markets affect your thinking today. You talked about trader or trading floor noise, and that was a sentiment analysis that guys on the floor would use. And I know guys, there were subscription services when they still had more of the floors. There's some still today. It's not quite the same, right? Where you get a mic down on the floor and guys would listen in who are used to listening to it that way, and they felt lost without it.
Yeah.
So, I mean, do you use any of those techniques, from open outcry markets, or you mentioned order flow earlier today, or the order book?
No, we don't anymore. Obviously, for me, it was going from the trading floor to, I was in the basement of a building just off Cannon Street, and it was one of those basements where it had like glass tiles in the actual path above, and you felt like you're in a dungeon. And but it was silent. It was just, I was one of the first there, and it was just the most horrendous thing. Just losing, it was like having a limb removed, or just like that sense, your sense had gone. And that you really relied on that, because if you looked away from the screen, you didn't know, because you use these green and black systems, the Eurex DTB system, was it DTB, I think, and it was just green and black. It was a very basic system, but it wouldn't show you where the market had been or over the last few minutes, So you could have got filled on an order which maybe was in the order book a lot lower or a lot higher, and not even realize. You'd have to go to another screen to update the screen to get your position. And so it was like, it was that time was, you know, when they started introducing Windows-based platforms and, you know, the TTs of the back in the day that was showing that sort of like depth of market, things started to become a bit easier. You were given a little bit more. You obviously still had to use your vision. You were given a little bit more. The squawk in the background was key as well. And that was, I think nowadays, it's still pretty key if you're trading full time. I know we talked about whether I trade or not still now, and I do a small amount of trading, but I can't trade in any way near the way I did before because it's a full-time job and you can't be doing anything else. And you would need them additional tools. I think, you know, Squawk services are quick, and the AI, the tools that Acuity are coming up with and firms like that are coming up with are, you know, are sort of like there's plenty more to come from that space. So yeah, it's an interesting time, and I think it's an exciting time. Time will tell. Maybe I'll come back next year, this time next year, and explain what else I've come up with.
Yeah, no, I totally agree. It's very interesting to layer these things in. You could almost call them some of the fundamental, you know, things with that news flow. But I think complementing, you know, your own existing sort of trading strategies, or, you know, in your case for the signal center analysts, that, yeah, I mean, it's, if you can almost give yourself a bit of a bias, but just putting yourself in with that little bit of an edge with what the overall flow is doing, as in news flow, then yeah, I think you're onto something for sure. Well, Steve, I think, you know, we've gone over a bit. I want to be respectful of your time. I want to give you a huge thank you for coming and spending the time with us here tonight. I've got a lot of takeaways and things I'm going to look up for sure.
No, you're welcome, Jeff. It's been great. I'm just excited to get out next week and sort of like come and see you all on Thursday, yeah, just sort of like it's nice getting out of getting out of the office, which is a home office obviously for a long time.
Yeah, no, same with me, and I think a lot of our STA members as well. We always love coming out to the events. We do these hybrid Zoom / in-person events, and then of course you've led me straight into the reminder about the event on the 22nd. So that's on the Thursday, I think, isn't it? Right?
That's right. Yeah.
Yeah. And so yeah, that'll be great. So look out for that one, and please come and join us there. And if you've got questions for Steve, feel free to confront him in person.
Yeah.
At the event. So yeah, I think that's probably all from us here tonight. A quick preview for next month. It's a live event, so as in an in-person event. So it's back at 1 Moorgate Place. The date is October I think it's the 11th. It's the Tuesday as always. And where we will be joined by yours truly presenting this time. So I'm going to be presenting to you guys live. And it's going to be based on a system we've been working on with a colleague of mine in the States, a systematic approach to incorporating a slightly tweaked PSAR that's got all kinds of great technicals included. It was specifically designed for crypto markets, but is not limited to the crypto markets. So yeah, I encourage you all to come out. There will be drinks after, of course, and I really look forward to seeing everybody. And if you can come in person, it's just even better. It makes the experience so much fun. So for everybody and for Steve, thank you again, and we look forward to seeing you all again soon. Thanks all.
Thanks, Jeff.